Just as global markets were getting comfortable with a strong dollar, a quiet but powerful signal has started flashing from Washington. For the first time in more than 2 decades, the United States may be preparing to step directly into the currency markets. And the target is the dollar-yen pair. According to recent reports, the U.S. Federal Reserve, acting on behalf of the Treasury Department, is preparing for a possible foreign exchange intervention. The plan is simple, but the implications are huge. Sell U.S. dollars and buy Japanese yen. If this happens, it would mark the first U.S.-led currency intervention since the year 2000, when major economies stepped in to support the euro. So why are markets paying attention right now? Because the New York Fed has already started what are called rate checks on the dollar-yen pair. These are informal calls to major banks, asking a simple question: where is the market trading? Historically, these checks are a warning shot, a way to signal intent without firing the first bullet. The big problem here is the yen. The dollar has been pushing toward and in some moments above the 160 level against the yen. That level matters because every time we've seen it in the past, Japan has felt forced to intervene. The core reason? Interest rates. The Fed is still holding rates around 4.5% to 5.5%, while the Bank of Japan remains near zero. This gap has supercharged what's called the carry trade. Borrow cheap yen, invest in high-yield dollar assets, and in the process, keep pressuring the yen lower. A weak yen doesn't just hurt Japan. It pushes up imported inflation, distorts global trade flows, and risks political backlash from trading partners. That's why coordination matters. Japan has intervened alone before, spending trillions of yen with only temporary results. U.S. involvement changes the game. History shows coordinated action hits harder and lasts longer. If the U.S. does step in, here's what markets are watching. Selling dollars and buying yen would immediately weaken the dollar against the yen, potentially by 3 to 5% in the short term. And that has ripple effects. A softer dollar tends to boost gold and commodities, U.S. and global equities, and emerging markets. We've already seen gold surge to record levels as these talks have gained traction. Japanese stocks could face short-term pressure. A stronger yen hurts exporters, but globally, risk sentiment could improve. Politics. Trump versus Powell, this also plugs directly into Donald Trump's long-running war with Fed Chair Jerome Powell. Trump has always favored a weaker dollar, arguing it makes U.S. trade more competitive. And while Forex policy comes from the Treasury, the Fed executes it. With Powell's term set to expire in 2026 and tensions already high over Fed independence, any market volatility from this move could quickly turn political. If assets rally, Trump may claim victory. If markets whipsaw, expect the Fed to take the blame. For now, no dollars have been sold, no yen bought, yet. But the signal is clear. The U.S. is watching the yen. The market is on notice. And if this line is crossed, we could be about to see a return of currency warfare in the global financial system.
Subscribe to One India and never miss an update. Download the One India app now.